Hello and welcome to this afternoon's live broadcast from PIF, the not-for-profit voice for regulated e-money and fintech payment firms. Our theme for today is Building Fintech Resilience, Lessons from a Crisis. And we're delighted to be joined by Paul Swinton, CEO of B4B Payments, Brian Lawler, Director of Sales from Banking Circle, Siobhan Moore, a partner with Lock Lord, and our moderator today is Mark Beresford with Edgar Company. Before I hand over to Mark, please feel free to use the Q&A box on your screen to answer any questions, and we'll aim to answer those at the end. So without further ado, I'd like to now hand over to Mark.
Thank you, Diane. Thank you very much. So great, I really welcome, delighted to welcome the panelists. I'm going to ask for Brian, Siobhan and Paul sort of just to give a little bit of an introduction to themselves, their business that they're involved in, and then we'll start the looking at 2020. Brian, do you want to kick off?
Yeah, thanks Mark, thanks Diane. Good afternoon everybody, and welcome. Yeah, just before I start, I'm just going to get this in quickly. I haven't seen that US lawyer. I'm a bit paranoid that a filter might come on and I end up being a cat. So just going to get it clear, I'm not a cat before we start, in case it happens. So yeah, so I'm Brian Lawler. I am currently just joined Banking Circle as Director of Sales. Banking Circle, who are a payments, cross-border payments business, working with all the regulated entities within the ecosystem. Just literally joined. Prior to that, I was at Wirecard Card Solutions, a name which is very synonymous in the news recently, where I was Director of Sales for the best part of 7 years, where I was responsible for client relationships, new business and marketing. And prior to that, worked for Visa and other payment businesses going back a number of years. And I've been on the board at PIF for the last 2 years now. Thanks.
Hello, good afternoon, everybody. I am Siobhan. I'm a lawyer. I head up the cards and payments team at Lock Lord, and I work with businesses who provide services in the payments services sector, whether it's an e-money institution, an issuer, payment institution, or a technical service provider, and it's helping them identify the risks associated with operating in that sector and helping them, of course, expand and broaden their business. I've been in the industry for best part of 15 plus years, and I'm also a board member of PIF.
Paul. That leaves me. So Paul Swinton, I'm CEO of B4B Payments. We're a regulated EMI in both the UK and now in Lithuania post-Brexit. So I'm also in the context of this presentation. Well, one thing, I'm also chairman of PIF. I should put that out there. But secondly, in terms of building fintech resilience, I think our firm was one of the firms which was caught up in the crisis with Wirecard last year, and the collapse of Wirecard, the group company. Obviously, Brian was part of the much more robust, more junior company here in the UK, which we'll thank him for his efforts. But we went through a lot of change last year, so it's a lot of resilience going on, having to become regulated in 2 entities, dealing with Brexit, dealing with the aftermath of Wirecard closing down in the summer. So it was quite a year. Over to you, Mark.
Thank you very much. And my name's Mark Beresford. As Diane mentioned, I'm a director at Edgar Company. We're a consultancy that specialises in payment strategy. So without further ado, 2020, looking back, it was quite a year for the history books. Numerous life-changing events, not just to mention the pandemic. There was the US election, there was social unrest, there's Brexit, the continuing story, the continuing saga of Brexit, the rolling lockdown, which impacted businesses to actually operate as businesses and also to serve customers. And then, of course, the customers who were in lockdown weren't able to do their normal things, such as, spend and travel and things like that. So 2020 certainly taught us quite a lot about building fintech resilience, and that's the topic of today. What have we learned from 2020? And let's just put this into context. What do we need? What do we mean by resilience? Operational resilience, the ability for an organization to anticipate, prepare for, respond, and adapt to incremental change and sudden disruptions. And we've certainly had our fair share in 2020. So I'd like to maybe just get the ball rolling, if we ask Siobhan, just as an independent advisor in the regulatory environment, and some of your clients, when you talk about resilience with your clients, what I know it's beyond risk management, it's not just risk management, but how do you look at it holistically?
Okay, so actually that's the key word, holistically, I think, is when you're looking at risk management is actually, or understanding the risks around you, it's actually being aware. So the first step you need to do is actually identify, understand your business, understand how you operate, who your customers are, what your products are, and understand the risks that impact them, not just now, but what possible ones can go in the future. And as you say, from a holistic perspective, it's not just box ticking, it's just not meeting the legal requirements, but it's actually you as a day-to-day business. So when you talk about the 2020, we look back at the year that we had, it wasn't just about actually, the huge impact has come from lots of unforeseen outside forces, apart from Brexit, which we had talked about for a long time, and a bit of social unrest that we saw was coming down the road. But the knock-on effect, the lockdown, the change in customer behavior, they are risks that actually a business needs to be aware of, particularly when you're very focused in operating in a particular sector, and what that change, what the impact is if your customers no longer behave in the way that you expect them to behave with you, so transacting with you on an everyday basis, because you're focused in travel, you're focused in retail, whatever it could be. So when we look at it and talk about risk, it's actually looking all around and at all the possible options, or see if you can identify what the possibilities are and how you can, as a business, then sort of safeguard against it. You can't in every day, you can't do everything, but actually if you have contemplated it, then there are possible steps that you can take in order to adapt your business going forward.
Same question to Paul. I mean, from a B4B point of view, I mean, you mentioned that you were operating right across Europe, your clients are right across Europe. How were your clients impacted as a result of the pandemic? I mean, that's the obvious question. And what sort of steps did you have to put in place? We'll get to the wirecard discussion later. But in terms of being resilient, in terms of servicing your customers, and being operational and keep going. And I mean, how did you address that?
Well, I think operationally, let's take that first of all. I think like much of the sector, I've been, had similar discussions over the past few months. I think many in the sector didn't struggle that much with operationally moving to effectively a work at home model. It was something that, it sounds very scary, but if you think back to almost a year ago now, when we were almost staring us in the face almost a year ago today, actually nobody be in the office ever again for the next year was almost unthinkable. And it was always like, oh, well, this will be a couple of weeks and then we'll be back again. So, it'll be fine. Here we are now. So in actual fact, when I look back, we as a business managed to deal with that very, very well. I mean, we went almost overnight to straight over working from home, had access to all of our systems, platforms, everything was in place and has been running, I don't want to tempt fate, but very smoothly for the last year, with everybody working from home. And I mean, now there are certain things that just don't happen as well. So communication at the water cooler, you know, that type of stuff just doesn't happen anymore. And even with tools such as Zoom and things like that, with all intents and purposes, the social aspect of working together in teams has changed significantly. But I think given where the whole world is, literally, I think we as an industry and certainly as a business have coped very well with that aspect of it. Moving on to our customers, well, I think, you know, we've got customers across many sectors. I think one thing we learned is, which seems obvious now when you look back, is don't have all your eggs in one basket. We were very highly weighted towards certain industries a year ago. You know, travel industry in particular being one of them, which has obviously dropped off a cliff. We saw 95% reduction in spend in that sector in 2020. So, you know, I think we've learned very much to adapt our products into other industries which are more relevant, and we were lucky to do so. So, you know, I think again, being, you know, a relatively smaller, more agile firm has given that opportunity. You know, it is easier to spin and turn and make hay, and you can see that, you know, in the retail sector. Suddenly you walk down the high street and all the restaurants are now suddenly grocery stores, or they're all now coffee shops. You know, this is resilience, and it's all about changing and retuning your business model to be adapting, to, you know, keep yourself alive, basically, in some cases.
Yeah,
adapting.
So, yeah, I mean, it's for our customers. Yes, some have been hit very badly. I mean, we work with a lot of tour operating companies, people that take people on tours. Now they've moved to a digital model. And obviously, you know, taking a bunch of students, you know, around Barcelona or whatever is very different to showing them on a Zoom screen or a YouTube channel. But, you know, there is ways to fulfill the pent-up demand, and hopefully when things do get released in the next few months, then that pent-up demand will be released and we'll all see a big boom as things, in whatever way they can, return to some semblance of normal.
And Brian, you mentioned that you'd recently changed roles from Wirecard, and we'll touch on Wirecard a little bit later on, because I think that's you know, obviously had an impact on the fintech industry as a whole. But from a, you know, banking circle, you know, has your business learned from 2020 in terms of resilience? How have you done things differently? What lessons have you learned?
Yeah, so I mean, 2020, what a year it was. You know, unforeseen, and, you know, touch wood, we won't see a year like it again. Hopefully, you know, in terms of, you know, our industry as a whole, we've had to deal with so much. You know, we had first of all, it was GDPR, then we had obviously Brexit, which is we're still ongoing with that right now. We have PSD2, all of these things, and then of course we have COVID, and which is we're still in the midst of now. I think what it's shown us is as an industry we are pretty resilient, and there are some positives to take out of this. If I go back into 2020, obviously I was at Wirecard, and for the first from when COVID hit, it was all about preparing our business, remote working, which we were able to deploy pretty efficiently as we were operating that amongst a large number of the staff anyway. And I think that's a positive that we'll all take moving forward. You know, we've all been guilty of being busy fools, I think, traveling around here, there and everywhere. And I think the way that businesses have now evolved into kind of remote working and so on, this will only kind of, you know, benefit the business as a whole moving forward. Wirecard was the biggest e-money issuer in Europe, and as such probably had more oversight from the regulator than anybody else. And it's interesting because we were already engaged with the FCA on a number of topics. One was the concern about, because of the COVID situation, the longevity about some of the fintechs in the space who perhaps were operating very close to the bone business models, should we say. And as such, the FCA had already kind of expressed a little bit of concern around that. And as such, we were reaching out to our clients. It was things like looking at their business model in a much closer way. monthly management accounts and so on. And then, of course, it was about having the processes and procedures in place in case of a wind down of any of our clients, or indeed Wirecard itself. So those discussions were actually ongoing prior to the situation that arose with Wirecard at the end of June, and subsequently what followed in the months that preceded. So I think, overall, there's a lot of positives to come from this. The situation from Wirecard, I think will turn into a positive, because the FCA obviously will recognise that, and they're doing this now, that companies, regulated companies, and companies that outsource their license to fintechs need to have the relevant processes and procedures in place, and contingency plans in place, should another situation arise from it.
We were talking and dealing with a Dutch client, and as a result of the Wirecard failure, and the perception that it wasn't regulated very well, or wasn't audited or whatever, and the scandal, there was a scandal, recognised scandal. It, in some ways, the regulators, this Dutch client was saying to us that actually the Dutch regulator is actually heightening, strengthening their regulatory handprint all over the regulated financial institutions, and making it harder for fintech. Is that something? Is that a bit of a negative fallout from the Wirecard?
Yeah. So first of all, just to kind of clarify and establish, the Wirecard Card Solutions, which was ultimately the e-money issuer of the Wirecard group, effectively was caught up in what happened with Wirecard AG. The business was a completely standalone, self-sufficient entity that didn't rely on the group in any way. Unfortunately, as a consequence of the FCA taking the precautionary step of suspending the license, which, although it was extremely painful for our clients and for us at the time, I can understand why they took that step.
And it was only temporary.
It was only temporary, and of course, the license was restricted. Was lifted, the restriction was lifted, sorry. As a consequence of what happened over that weekend, a lot of the biggest clients that Wirecard Card Solutions had already either had their own licenses that weren't being used, or were kind of far down the track with getting a license, so the situation made them kind of accelerate the process. So as a consequence of the biggest clients leaving, it meant the longevity of Wirecard Card Solutions wasn't possible. So therefore we had to go into a kind of wind down process. But the regulator, prior to this happening, were already taking a much closer and deeper look at not only Wirecard Card Solutions as e-money issuer, but also our clients, and indeed, our competitors and other players in the industry. So they had started to do that anyway, and we welcome that, and certainly I think that will only benefit the industry as a whole from any future car crashes. Now, we already had experience of a car crash, which was Loot, which was a client of Wirecard Card Solutions, went into administration, and they went into administration overnight. There was no warning. We had no warning, but thankfully we had the right procedures and policies and procedures in place to step in and ultimately take over that business. We deployed a team. We did it. We have the experience. The people have been within Wirecard Card Solutions for a long time, vastly experienced, and we managed that in a very efficient and satisfactory way for everybody concerned, but none more so than the customers ultimately, and that's what we're here to, or the regulators there to protect. So we did that. So the regulator and the FCA were kind of in that frame of mind anyway because of the COVID situation. And I think, as I say, with what's happened with Wirecard, retrospectively looking back, that's only going to be a positive now moving forward, because they are going to ensure that everybody that's regulated has the procedures and policies in place should one of their clients fall into difficulty, or they themselves fall into difficulty. But I think there's still a lot of work to be done. But I think all in all, moving in the right direction.
So Siobhan, maybe if I could ask you the same question, is do you think there's been a positive fallout from the Wirecard from a regulator's point of view?
So I'm glad you asked me, because I was about to jump in and ask Brian and you a couple of questions. Do you think the regulators actually understood the business models? Because we know from the industry that they're highly, it is commonplace that much of the services are outsourced. So they're quite complex business models in terms of, it's not just e-money, they're not very simple products anymore. They are transaction account services that can be quite complex and sophisticated. And then at one end, you've got simple gift cards, and then you've got sort of full-on transaction accounts at the other end that look very similar to everyday accounts, deposit accounts or what normal sort of accounts that banks will provide. So the outcome. So my first question was that was the regulator, FCA, learning from Wirecard on the back of that? Because was there real understanding about how these business models operate? And I do question whether they actually had a full understanding. And to your point, Mark, when you're talking about your experience with your Danish client, it struck me that probably the regulator there in other jurisdictions didn't understand, and still maybe perhaps don't have a full appreciation of how these business models are operated, because the implications and the fallout is incredibly wide. And that's what Wirecard, as a bystander watching the action with Wirecard, that's what we saw, was that the impact was incredibly was wide. It hit all sorts of businesses, and it hit all sorts of customers in all sorts of ways, those that are very vulnerable as well as those more sophisticated businesses, and they should be treated in a different way. So I'm not quite sure whether that was sort of a bit, that was an observation I had. The learnings going forward from coming out of it is, I hope they have a better understanding. So situations like this will certainly help give a greater insight, or sort of educate the regulator in understanding the business models going forward and what the implications are. In terms of the positives that come out of it, I think actually it is a test. It's actually for all businesses to understand what they need to do in order to protect themselves going forward, and it's bringing it to front of mind. We've had quite a buoyant few years of fintechs being quite successful, up and running and taking off. Actually, it's great to focus on a business and business growth, but actually what we all need to do, and this is where the lawyer steps in and the compliance bits, and saying, well, hang on, what happens if things don't go the way you want it to? And that's where it's important. And that's having a business, including that as part of its everyday board decisions and management, is critical. So I think that's a positive that has happened as well.
So Paul, do you think the regulators are more educated as a result of Wirecard? I mean, I'm not.
Yeah, I mean, I think
about
that,
the FCA. I'm talking
were,
about regulators in general.
I can't speak to regulators in general, but for the FCA specifically, I mean, I was a client, as I said, of Wirecard's at the time, and we were requested to go on a call with the FCA to explain effectively our business model, where we were in the ecosystem, who our clients were, what the types of products were. And it was very clear that this wasn't the first conversation they've been having with, I think, other clients of Wirecard. But it was pretty clear very quickly that no, they didn't understand, the vast array of products that were being produced and were in the marketplace. They didn't really understand the risk models of each of those businesses or the products of those businesses, because, as Siobhan just touched on, a gift card, a lot of people, regulatory I think included, prepaid, oh, that's gift cards. Well, no, it's not. It's like millions of other things. And some of the things.
What about your Lithuanian? What about the Lithuanian counterpart?
Yeah, well, I think, to be honest with you, I mean, I think it's been, if I'm really truthful, I mean, obviously going through a license with a new regulator is quite a challenge anyway. But they have had great scrutiny over the process, and have got into a great amount of detail at this stage, onboarding new clients to understand the business models, and actually are aware. You know, it was actually quite refreshing to have direct conversations with a real person before and during the application, where they clearly kind of knew the marketplace and could ask really sensible questions about our specific business model. So yes, I think if that's as a result of this crisis, I don't know. Is that just a, you know, being a good regulator? I don't know. You know, but I think, yes, there's been a lot of lessons learned. There's certainly been a lot of, you know, there was certainly a lot of press, and there's a lot more going on, and we can see it now. You know, as part of PIF, we're being invited to join the FCA on Q&As to talk about our constituent members, explain business models, give input, and really have a two-way dialogue, which is really refreshing, actually.
I mean,
sorry.
I was just going to say, Mark, yeah, so like I said earlier, the FCA had taken a much more active, because of the consequences of COVID, and there was a nervousness around the long-term sustainability of a number of fintechs, should we say, in terms of their business model. And the FCA had started an exercise literally not long before the Wirecard news broke, where they wanted to understand from us the business model of each of our clients. Now, in defense of the FCA from that regard, we had over 400 programs ranging from, you know, all types of different products like you've touched. So there's a lot to comprehend and to learn, and you know, to their credit, they were open and learning about that. And then of course the Wirecard situation happened at the end of June. So then obviously all the energy and focus then was about managing that situation out. But yeah.
And do you, I mean, last year, again, you know, related to the FCA, they published a survey that they'd conducted, I think just before the lockdown one, and I think it was between February to June, I think, the survey, and they had identified 4,000 regulated financial institutions that had heightened risk of failure. I think that was the terminology, and you know, as a result, a direct impact of the pandemic. And it kind of is quite a comprehensive survey, you know, and in the scale of things, it's, you know, they regulate 60,000 businesses, and that, you know, represents almost 7% of the total number of financial institutions. You know, is that normal, or is that, you know, was that survey timely, or was it just, you know, bad press? I mean, I know it was reported, and it, you know, was it scaremongering, or was it, you know, what's your perception? I mean, we've all seen the survey, we've all seen the results. Maybe I'll direct it to Paul just to kick off this topic.
Yeah, well, I mean, that was the first of a few surveys. There's another one actually just finished last week, actually, where they've asked another subset of similar questions. No, I mean, I think they're doing the right thing. You know, they regulate the financial industry. That what they're asking is, you know, number one, have you got, is the regulatory capital that you're required to hold robust? Is there enough money there to keep you going? Are customers at risk? And I think those are perfectly reasonable questions to be asking. And they should be asked. You know, is 7,000 of 60,000 significant? Well, you know, actually, if you look at much more widespread business, there's probably a much higher. Well, if you take away government support, there probably should be a much higher degree of risk in the wider businesses. So is 7% a high number? Probably not, to be honest with you. But then you wouldn't expect that, because financial services firms, by their very nature, need to have, you know, a level of robustness about them. So no, I think it was absolutely the right questions to ask, and they should continue doing so. You know, I think that there are some more specific questions in our own e-money and payment providers industry around safeguarding and so on, which they were also asking, which they also should be asking. You know, are people using financial trickery to come up with how safeguarding is being done? Are the right things being done? Is it clear? Is it being done daily? Again, is there any risk to consumers or consumers' money? all those questions should be, a resounding no. There should be no risks, and they're doing absolutely the right thing by checking on them. And and if any of those firms are in those categories and they are at risk, then they need to be taking steps to provide additional resilience, whether it's capital or processes or whatever it is they need to do to fulfill those areas where they're falling down. They need to make those things happen.
And I guess, Siobhan, the FCA it is in their interest to continue to do that sort of research and then react and adjust and adapt the rules and regulations and the business conduct rule book. Now I understand that they've introduced this robust wind down plan. I think all financial institutions. I don't know whether you've directly been involved in that or you're aware of it. Is that something that is a good move? Is that something that we've learned from 2020?
Well, I think it's part of, so just the first point, I think it's absolutely right. The FCA does keep tabs on the firms that it has oversight of to understand what risks it's exposed to. First of all, to the businesses, so communicating what their findings are to business to make sure that they are, to let businesses be aware that they are monitoring it and perhaps that something needs to be done, and perhaps that means going further down the line, changes to rules and regulations, for example, having a robust wind down plan in place. I think that makes sense. The bit that I would be very wary of is when you have stats like that coming out, when you say 4,000 firms are at risk, who are you communicating that information to? Because if that goes out into the marketplace in general, and we're talking about e-money firms, payment firms, and then on the back of that, it gets picked up that says, oh, these aren't covered by the FSCS scheme, you are creating unnecessary problems and issues that were not necessarily warranted to be out there in the marketplace. So you have to be very careful with that kind of information. But fundamentally, to ask those questions in the first place is very important. For the wind down plan, I was involved with the FCA, where the FCA have given feedback about their proposals and what their expectations when they did the review, and what they're expecting to have in wind down plans. It makes sense to have it in place. And the interesting thing is that the observations when they looked at the wind down plans of existing businesses or firms is that they were either template format, they weren't personalized to the business, they did not cover all the areas, and they sort of miss some fundamental things, which is about IT resilience. It's about making sure that your service providers continue to provide services in a wind down situation. Your IT is resilient. You keep looking after your customers and the customer services. They're all actually quite valid points. It's quite nice. It's refreshing to see that the FCA are giving some sense, sort of good feedback about what their thoughts are. It's difficult for a business. I understand that's focused on trying to keep business going, particularly in these testing times, to perhaps ensure that it's meeting all the FCA requirements to put these plans in place, but it's there for good reason. And actually, it's something that no business should be ignoring, because they are very, very real risks.
Yeah, it's interesting. You mentioned the boilerplate template type of models that were being presented. I've already heard that. But Paul, just back to your point about the survey. Did you perceive that it was potentially being scaremongering, and depending on the press, if it's being read by day-to-day man in the street, consumer, 4,000 financial institutions are at risk. I mean, the man in the street probably has one or two relationships with one or two financial institutions, maybe more. Is that going to send the wrong message to the consumer?
Well, I mean, it all depends on how you construct the press release and how the press pick it up and actually do what they do with it. I mean, inevitably, statistics can be used, as we all know, and manipulated to have a the presenter wants them to be taken. And you know, I don't think anybody was trying to do this maliciously. I think what they were doing was they were trying to understand, is there this systemic or problem in the industry? And the only way to do that is go and collect data, and you know, apply their own criteria to that data to come up with their own results. Really, I'm not sure they ever did it as a way to sort of go out and scare.
No, I'm
the
sure.
industry, because let's face it, the man in the street is all dealing, you know, for the most part, you know, despite the best will of the fintechs in the world, they're dealing with a handful of large banks, most people. So you know, they're probably not going to be scared by that, because you know, we don't know the breakdown of this 4,000. You know, was what sectors were those in? Was it you know, FX traders? Was it, you know, what insurance salespeople? Who was it? We don't know. So
it's the key is context always. You always need the context of that data, you know, when that data like that's being delivered.
We're all flooded by statistics, and every single day at 5 o'clock there's a new set of statistics come out. You can read into them what you will, really. So and
you didn't get consumers banging on the door of Barclays and saying, "I want to withdraw my money."
No. It was not, that particular phenomenon was a decade or so ago.
So just touching on, I think somebody mentioned IT resilience. I think Siobhan mentioned it. I think that's quite an important element. Have we seen, you know, with as a result of everyone, you know, suddenly being working at home, that's not just the banks. I know my bank, you know, if I have to phone my bank, it's very rare, but when I have to phone them, I do feel as though I am waiting a lot longer, and I possibly could be hearing children in the background simply because the call operator is working from home rather than a warehouse in Sheffield, whatever. So did it, you know, customer service, you know, and IT resilience, has it been ready, you know, to be able to anticipate this? Suddenly everyone's working from home, you know, almost overnight. As I know in your own businesses and in our business, there's so much in the cloud. There's so much accessible through the internet and through secure, you know, ways of getting at it. It's been quite smooth, you know, as far as our business is concerned. I think Paul mentioned it was relatively easy to, and you couldn't anticipate, you know, a year ago you'd be still working from home a year later. What about customer services and IT resilience? Is that, are there any, you know, maybe, you know, Brian, have you seen anything from your point of view, from your customers?
Yeah, no, like I said earlier, I think, you know, we and broadly across the industry were mostly prepared for this. I think the ability of working remotely and accessing systems remotely, obviously securely protected, I've been in there for a number of years. If I talk about myself personally, I've been remote working for 10, 12, 13 years, you know, a long time. And, you know, with any kind of modern company, there is that ability to do that. And I think, you know, from what I can see within the industry and broader within the industry, I think companies have handled it pretty well and been able to move very quickly. Those that haven't maybe had that kind of access to that kind of remote IT services. So, but like I said at the beginning, I think this is a real positive to come out of this whole situation. Is that, you know, do we all need to be traveling around all over here, there, and everywhere, or spending money on expensive offices in London, when people can do a just as capable, if not even more efficient job working remotely, you know? So I do think that's going to be a positive. I think, although one concern with that would be, well, if they can work remotely from, I don't know, up north, they can work remotely anywhere in the world, you know? So maybe that's a bit of a threat as well.
Yeah. Do you start to lose staff who are going to actually end up on a Caribbean island working remotly?
Well,
what's wrong with that?
I mean, I can talk to that. We had staff that went abroad for personal reasons before Christmas. One has just managed to get back from Brazil. One was in America for a period of time, but they were all working at 9 o'clock in the morning until 5 o'clock at night UK time, and actually it was irrelevant where they were. So I mean, you know, I think we'll see an increased incidence of remote working, and you know, I think there's a huge amount of benefits from that. But I still think that what we're beginning to see, if we haven't already, is that the social structure is obviously changed significantly. So whilst you know, there are people obviously with personal circumstances that don't want to work from home because their home is too small or it's not ideal. So, you know, they just want to be in a bigger space. And there's some people, frankly, just want to get out of the house. And, you know, so, I mean, those are all COVID aspects as opposed to long-term ones. But, you know, I think the ways of working are inevitably going to change, but there still will be a need for group get-togethers. And that's only to benefit, you know, teams, know whether that's once a month, once a week, you know, twice a week, who knows what that model's going to look like in the future. But there's still, I think, a huge need for collective get-togethers in some shape or form.
I agree, Paul. I think these virtual beers aren't really the same thing, are they?
No, it's all too easy to switch the camera off. That's the problem.
Well, you should try virtual chocolate making. That was one of our Christmas events. And I think it's interesting you talk about the social events. I think if you're younger, you're new in the industry, you're possibly single, in a flat in central London or wherever, might not get the space, and a lockdown situation, it's not good. It can actually be mentally challenging. Have you seen anything that in your staff, you know, just in terms of the operation staff and the younger generation, are they finding it harder than say you and I, who might be at home with kids and family? And
I think it's across the board, quite honestly, Mark. I think some people.
You can't wait to leave.
Well, no, not personally speaking. I don't want to obviously, you know, pigeonhole anybody, but no, I think that, you know, across the board, people have got different issues with different ways of working, and some people cope better than others. Some people, you know, don't, and we need to be just collectively aware of everybody's, you know, preferred ways of working. I think that's the difference. That whereas I think in the future. Whereas in the past, you know, it was basically you have to turn up 9 to 5. That's your job. That's going to change in the future, and it will be much more flexible. At least from our perspective, it's going to be much more flexible around what's the best way that we can work together for both the well-being of the employee and the business itself.
And I think from a learning perspective, when you're dealing with people who are new to a role, it's working with someone who has more experience in that role, or can help them with managing new situations that they may not have come across, in just to manage that, but also as to understanding how a business, that business approaches a particular issue that it faces and how it manages it is pretty important. But it doesn't mean you have to be in an office every single day. It's about being a little bit smarter and having sort of different communications or different communication networks available, so that that you have greater flexibility. So unfortunately, instead of us being online 24/7 with just an email and our laptops, we're now, what is it, sort of 24/7, well, sort of we're never going to sleep now, and we've got sort of Teams meets, we've got Zooms, or whatever it is, and internal sort of communications. We're opening up more and more ways to speak in a real-time manner to help our colleagues cope with these things. So it's a bit of a challenge, because in one sense, it's great to be a remote worker and have that flexibility, but actually with that, you're opening up other avenues of communicating, and sometimes it's quite difficult for individuals to switch off and manage those appropriately. And I've been remote working for years, and I think probably we all can nod and say we're still learning how to manage our on and off time, because one of the fallouts of being sort of remote working for so long, is that our days are much more blended. So we don't officially clock on. Well, I don't clock on at 9. I don't switch off at 5 o'clock. It goes on continually, and that's in between meal times and sort of family time and all sorts of things. So we've just got to be a little bit better and help ourselves work out how we can manage that better. It's
interesting you picked up on the point about new recruits. I think we've got a situation where we were hiring last year, and we've not actually physically met them.
Yeah, isn't that crazy?
Isn't that crazy?
Yeah.
And how do you?
I opened an office I opened an office in Vilnius and haven't met any of them.
Do they know they work for B4B?
Oh yeah, I talk to them every day.
So that's interesting. That's interesting. So changing tact a little bit. I know we want to address the Q&A which is coming through. There's we mentioned high street. You know, the high street's changing landscape, and there's some big name brands that have gone out of business. You know, Debenhams, Arcadia, which is kind of part of Topshop, Burton's, Evans. Now this is obviously retail, and we all know what happens at retail. You spend your money, or you're meant to spend your money, and using your credit or your debit card or your e-wallet. Now that's going to have an impact on fintech in some ways. What lessons are we going to learn from that? You know, that is it going to be a complete shift to e-commerce? Are people going to drift back to the shops when they eventually get open up? Or is there a sea change happening here? Has e-commerce leapfrogged 5 years ahead? What's your perceptions? Brian, maybe kick off.
Yeah, no, sure. So I think the retail sector as a whole has been struggling, should we say. We've seen a lot of these big retailers that have gone into administration, then they've been saved, they've shut a load of stores, and in parallel to that, obviously the e-commerce boom has been continually accelerating. Now, what we've seen from the COVID situation is that it's accelerated it even more at an unbelievable pace, and what it's also done is the kind of deployment of the digitalization of payments has become accelerated, and that's where people in our industry, I know fintechs, have really kind of evolved and benefited from this, much able to kind of evolve and develop and react much quicker than the traditional banks, should we say. And we should in many ways be thankful that the industry that we work in, we're always going to need payments, right, in whatever form that is. And I think that's probably another area that's kind of helped accelerate growth within our industry. Sorry, Mark.
Yeah, I'm just going to say, to your point about digitalization of payments, is it the death nail of cash?
I don't think we'll ever see the disappearance of cash. But I just don't think we ever will. But certainly, I think it would be really interesting to see what the latest kind of that the market kind of share would be between non-cash and cash right now, because certainly the percentage decreased. We've got a virus out there at the moment. We've seen a lot of retailers stop taking cash. They only accept cards.
Exactly.
Exactly. So but
there's less ATM withdrawals, apparently.
Exactly. So in answer to your question, cash will never disappear completely, but certainly the global pandemic has actually helped the kind of the disappearance of it, should we say.
Siobhan, any thoughts on cash or e-commerce?
So interestingly, I was listening to KPMG. They were talking about the retail market, and they've been tracking it for many years. And I was listening to a couple of guys talking there last year, and as an industry event, and a couple of observations were that the high street has been in decline for many years. There are, and had been pre-COVID, pre-Brexit, pre-even 2008 crisis, there are far too many high streets for our centre. It's built on, you know, sort of not Victorian times, but so days of old when we had lots of little towns and lots of high street stores. With globalisation, it changed beyond recognition. So as Brian said, the change was coming, and COVID has just accelerated it and literally put some jets underneath the path that it was already following. Interestingly, you know, with Arcadia going under and Boohoo purchasing, you know, sort of the brands, that's a totally online proposition. And when we look at our brands in our high street, it's filled with Dorothy Perkins, you know, top shops. There are corner brands that we have in there. So it's going to change. The faces, the face of our high streets are changing significantly, and it's not going to go back. But retail, a bit like working from home and having business centres, we don't just go into the office to do our job. We go into the office for a number of reasons. The reason we go into purchase, we go into town, we don't just go in to purchase milk and clothes. We actually go there for social reasons as well. So our high street is changing. So the purpose of why we're going there is changing, and it's going to meet our social needs as well. In terms of cash or e-commerce, bricks and mortars standalone won't survive. Bricks and mortar businesses, but bricks and mortar complementing a digital business, an online business, make perfect sense because it meets that personal contact. We all like to see things and experience things, as well as having the ability to consume things just at the touch of a button, or purchase things.
More showrooming.
Yeah. Absolutely, absolutely. Or environment, yeah, totally showroom to purchase or to experience something.
Yeah.
So that is actually going away. Cash will never get rid of. There is a lot to be had with cash, from a physical feeling of seeing something, as well as just having it as a currency. So that is a complementary sort of a tool for having cash as well. So I don't see it disappearing. I see it as being a part of it, but not having much less cash in the system. And of course, most businesses, my children, you know, have long since moved on to digital, you know, sort of financial service products, because they the way they interact and the way they go shopping is very, very different. So we're going to live with both.
Yeah, and I think that's a good point. I think go back to Paul, ask the same question. I don't want to go off topic, you know, because we are talking about resilience, but I mean, it is important that has the pandemic, as the disaster of 2020, has that meant that e-commerce and the demise of cash has been speeded up somehow, fast forwarded?
Yeah, I think without question.
Right.
Without question. I mean, I'm slightly more bullish on cash disappearing, as I haven't actually physically used any cash since November, and that was for the last proper haircut I had before this DIY job. So, so I think we've seen a lot of moves in using cards and electronic digital cards in industries which previously used cash. Cash disbursements have all but gone away, or are going away. We're still talking to companies now that have had previous cash or other disbursement methods that they want to replace with digital or cards. So it's opened people's eyes, and people see that's the way the wind's blowing. Now, like, it's very different for people like me that live in the center of a city to say, you know, it's easy for cash to go away, because most of the shops, you know, some don't take cash anymore. Most that did take cash are now overnight have got digital acquiring solutions, whether, you know, and that's been much more prevalent. Handheld stuff, you know, no more the method and the tools available to retailers are now, well, they were always there before, of course, but they're now much more, you know, it doesn't cost them as much anymore. You know, it's much more accessible. They know that the costs of banking with cash are going up. They know it's more difficult. The banks only open certain hours anymore for them to go and deposit those cash. So, you know, it's all a move in the general direction.
I think that's a good point, Paul. It's not just COVID necessity, it's the cost economically. it's worth their while moving and making that shift to taking sort of on, you know, sort of card payments.
Yeah, and that was
regulated.
before. Yeah, that was also, but the cost now of handling cash and the inconvenience now of handling cash for retailers, banking it is significant. And so, whereas it was borderline before whether to accept card payments because of the acquiring PSP costs, now it's a no-brainer. And the consumer is almost demanding it as well. So it's like another push in that direction.
So it's a tipping point. Just conscious of time, in terms of moving forward, what, you know, we've seen the pandemic, we've seen Wirecard, we've seen Brexit. Do you think, what is the future challenge on the horizon? What, you know, I'm going to put one out there. I've got a theory that actually climate change might be the issue in the future, and that's going to have an impact on, you know, wider consequences. I think we saw Mark Carney talking about that recently, the ex-Bank of England governor. So I'm just interested to get your perspectives. Maybe start with Siobhan. What do you think? What do we need to be resilient about in the future?
Oh, okay. I agree with you, by the way, for climate change. I think actually it is it's a massive issue. I think it's really a key factor, and actually consumers will sort of are much more mindful of that going forward. There was an article that came out, for example, we're looking at cryptocurrency, and they said sort of the cost of mining for Bitcoin is the same for powering Argentina, or something like that. In you know, I suspect it's slightly exaggerated, in a week or whatever, but it was just, you know, there are sort of, arm people with the information, they'll make decisions, and that will certainly have an impact. Something I think that for arming businesses going forward, I think actually it's being, you know, we talked about being agile, business being agile, but the other thing is it's actually knowing who your customer is and looking after them. If you can manage that in a customer service perspective and keep your and sort of focus on that, it's an often forgotten part, but I think it's a critical part of delivering a successful business.
Ryan, same question. What's the future thing that we now have to be resilient for?
Yeah, well, I think we need to, like, just touch on something Siobhan said, is knowing your customers, you know, knowing their business model, knowing your own business model, you know, being resilient around that. There could be some changes coming afoot. We could see negative interest rates on cash. This is obviously something that we're going to be lobbying against, should that be the topic as an association. Is there going to be, are we going to have a bit of a financial recession crash as a consequence of what we've been through? So I think you know, these are the challenges that we face, and it's having, you know, strong processes and procedures, contingency plans in place to ultimately to get through any scenario that may be thrown our way in the near future. You know, additional intrusion from the regulator, you know, what that brings, the, you know, the drain on resource and so on and so forth. So yeah.
Very good, very good. Paul, same question. What do we need to be aware of in the future in terms of resilience?
Okay, so I think, you know, one sort of far-reaching is Brian touched on it actually, is paying the costs of all this pandemic back. I mean, how do we not, you know, saddle our children with the debts of you know, so, and I don't have an answer to that at all. I mean, you know, higher pay grades than me, they would need to figure that one out. But you know, there's a critical social impact going to take place for paying this all back, or you just run at a budget deficit for, like, you know, centuries to come. You know, I think on a more tactical, more sort of bringing it back down to the industry and so on. I think, and Sean touched on, both Brian and Sean touched on this, but you know, we have to be looking into the distance 360 degrees around us to see what's coming. And I think it's been very easy over the years to look in it yourself, at your own business, and if it's ticking along nicely, then, you know, all well and good. And it takes something like this to come along and really shake things up, and it makes you think, once you've dealt with the 2020 firefighting and crisis management, which was 2020, you know, emerging into 2021 now, it's much more critically looking at yourself as a business, ourselves as an industry, and the world in which we exist, to see where are those opportunities and threats coming from, and trying to plan for those. You know, stop making a risk assessment something that you do once a year and stick in a cupboard and tick a box.
Exactly.
Actually use it for a tool to open up conversations with your management teams, with your staff, with your advisors, and with your suppliers and customers.
Diane's back on, so I'm sure we've run out of time. I wanted to summarize, you know, if we've basically we can survive 2020, we can survive anything. So it's all about agility, scalability, and resilience, and taking a holistic approach. I think that's what I've heard from Brian, Paul, and Siobhan.
Thank you.
Fantastic.
Mark.